Yeah, it's Gautam, welcome back. So I know it's been a while. Okay. So in this video, what I'll do is I'm here to discuss a very interesting enterprise software company, which is Workiva. Okay. And since this is an education channel, okay, so what I'll do is I'll take you through the framework that I use to analyze a business, to assess moat in a business, okay, and also how we should be thinking about value. Okay. So as always, this video should be helpful for strategy consultants, equity analysts, business analysts. All right. Okay. And please write to me if you have any questions. Okay. Now, talking about enterprise software. Okay. So enterprise software and even services, they have experience, they have borne the brunt of AI. Okay. In fact, for all enterprise software and services, they have experienced significant valuation compression. Okay. Uh, and the AI and semiconductor companies, of course, have done really well. Okay, and there has been a lot of fraud, valuation fraud that has accumulated in that space. But some of the fraud is just beginning to dry up. Okay, and then gradually, enterprise software and services, they are beginning to find their footing again. Okay. Now, in fact, if you talk about enterprise software firms like SAP, ServiceNow, Adobe, okay, Salesforce, okay, all of these enterprise software firms, they have experienced significant decline. In fact, let me first take you through, just show their what kind of valuation compression they have seen before we get into Workiva. All right. All right. So hope my screen is visible. Okay. So if you look at this, if you look at my screen, if you look at this charts, this is for Salesforce. Yeah, if you look at the Salesforce chart, look at the decline it has experienced over the past year. Now, only recently it is beginning to kind of inch back up. Okay? And same story with ServiceNow, same story with Adobe, okay, and same story with SAP. If you pick any enterprise software and services, the same story kind of repeats itself. Okay. And of course, why that has happened is because of AI, because AI would or eat into their revenues. All right. Now, it's important that we understand that how these enterprise software businesses they make money. Okay, how do they make money? Okay, so for the most part, they make money through something which is called seat-based licensing. Okay, what is seat-based licensing? Okay, so uh, these enterprise software firms they charge based upon the number of users or number of people, number of humans buying their software. Okay, for example, let's take Salesforce is an example. Again, very simplified, rudimentary example. Okay. So Salesforce is in the CRM customer relationship management enterprise software space. Okay. So let's say Salesforce has Unilever as their customer. Again, I'm just making it up. Okay. Now, so let's say Unilever has 100 people working in their Unilever has 100 people working in their CRM uh, function. Okay. So Salesforce will charge a licensing fee for each of those 100 people working in CRM. Okay, that's how historically Salesforce and all these companies they have made money. That as AI agents, they do the work which is previously done by humans, by people. Okay. So the software price per human seat, it faces revenue decline because see, every role that an agent automates, okay, is a seat that stops renewing. Okay. So of course, the revenue, the product revenue by all these enterprise software firms, it shrinks. Okay. So that's the major risk, okay, that is being experienced by all these enterprise software firms. Okay, and all of them they are scrambling to charge to make money, to charge not based upon the number of humans, okay, but rather charge based upon the outcomes that they deliver. Okay, so it kind of change their the way they make money. So not charged basis every not charge the licensing fee per human, but charge it based upon the amount of work that any organization can do using their software. Okay, which is called value-based pricing or outcome-based pricing. So all of these enterprise software firms, in summary, they are scrambling to move away from seat-based licensing to value or outcome-based pricing. Okay, right. So this is what is happening in this space. Right. Now, getting into Workiva. So Workiva is a much smaller enterprise software firm. It's under 4 billion in market cap. Okay, and one thing which is very interesting about Workiva. Okay, and before I get into what is interesting about Workiva, uh, So Workiva, it has experienced the same kind of decline valuation comparison as some of the other software firms, and now it's kind of inching back up. Okay, and as I said, its valuation is under 4 billion in market cap. Okay, so what Workiva does is it helps its enterprise clients prepare and automate these financial filings, those SEC filings in the US, the 10K, the 10Qs, what have you, and the ESMA filings in in Europe. So SEC and ESMA, they are akin to SEBI in India. So it helps with all those financial disclosure work. Okay? And not only financial disclosures, but non-financial disclosure as well, right? Regulatory compliance, the SOX, Sarbanes-Oxley in the US, plus any ESG and sustainability reporting disclosures, which are a big thing in the UK, in Europe particularly. Okay, so this is what it does, and so Workiva, it serves as the definitive reporting environment, and it ensures that across that all the enterprise disclosures for a business, regardless of whether they're financial or non-financial, all enterprise disclosures, they are audit grade. Okay, and data, okay, in all those disclosures is traceable. Okay, so that's which is something which is very important and something that we'll get into in detail in a bit. Okay, now I said what makes Workiva interesting is that, like other software businesses like ServiceNow or Salesforce or what have you, okay, like all of them are scrambling to and pivoting away from seat-based licensing to value-based licensing. Workiva doesn't have to do that. It doesn't have to pivot, okay, because Workiva is already in value-based licensing. Okay, all right. It has been charging its customers based upon value-based licensing since 6, 7 years. So Workiva is kind of saved from that scramble. Okay, so which is something very interesting about this business. But then, like many other SaaS software as a service companies, Workiva's valuation, as you saw, has also been pressured by concerns that AI could commoditize compliance work, because this is what it does, right? It helps with compliance work. So the concern is that AI could commoditize this compliance work. Okay, but one could argue the opposite, that as AI enables organizations to generate more and more content and reports at scale, the need for auditable, auditable and trusted reporting compliance will only increase. Okay, which is precisely the capability that Workiva brings to the table, right? So in that sense, AI may be more of a tailwind than a headwind for Workiva. Okay, so another reason that makes Workiva very interesting. All right. So now let's get into Workiva. So we'll specifically look at three things. Okay. One is I'll take you through the value framework. See, understanding the value framework is critical for business analysis and valuation. Okay. So that is one. So we'll understand the value framework. Two is I'll take you the framework that I use to assess moat in any business. Okay. And we'll apply that framework to Workiva. Okay. So that's two. Three is I'll also walk you through the outcomes of my DCF valuation of Workiva. Okay. Those are three broad things that we'll do in this video. All right. Okay. So first, let me take you to the value framework. All right, so what you see on your screen is the value framework. Okay, see, you may be an equity research analyst, you may be an investor, you may be a strategy consultant, a business analyst. Okay, so one thing that's very important or fundamental to keep in mind is that anything that a business does, okay, should eventually trickle down to operating margin, profitability, capital efficiency. Capital efficiency is the efficiency using which a business deploys capital. Okay, meaning that it's a revenue generated per dollar of invested capital. Okay, so anything that a business does should drive margin and capital efficiency. Combination of margin capital efficiency is ROIC, return on capital. Okay, right, and then okay, not only ROIC but growth as well. Okay, so essentially, okay, growth and ROIC are the two super rolled up metrics, okay, that we got to be assessing for any business. And of course, we need to double click into what factors they make up, what drivers they drive growth, revenue growth, and then what makes up ROIC. Okay, but these two metrics are critical. Okay, and then a combination of growth and ROIC, they generate free cash flows. Okay, so both these two metrics combined, they lead to value being created, okay, for the shareholders. Okay, all right. That's, and of course, so basically valuation. Okay. Now, one thing more, one thing also very important. Okay, see, uh, growth, margin, and capital efficiency. Growth, margin, capital efficiency. These are three essential ingredients for you to value any business. Kind of goes without saying, but something which I've said repeatedly in my videos. Okay, that these three are the important ingredients that you need to value any business. Okay, and I'll bring this to life in the later part of this video. Okay, right now, let me further round up your understanding. Okay, let me go to the next slide. So, what Warren Buffett has said is the truly great business, okay, must have an enduring moat that protects excellent return on capital. Okay, and he goes on to say that there is no one formula in finance that you can use to measure business moat. The all-encompassing metric that comes closest to measuring business moat is ROIC and ROE for financial services. Okay? So, in conclusion, what he's saying is a business which can demonstrate uh, high return on capital for a significant period of time is able to do so because it has more. Okay. In fact, not only ROIC, but just making sure that why this print doesn't work. Growth and ROIC. Okay. These two, for significant periods of time, if a business delivers in growth and ROIC for prolonged periods of time, then the business is able to do so because it has some competitive advantage vis-a-vis others. Okay. That's what is being said. And these two are the very metrics that we looked in the last slide. Okay, because these two metrics in combination generate free cash flow, which creates value, okay, for shareholders. So this is a good segue into the next portion of the video where I discuss my moat assessment framework. Okay, see, growth and ROIC, think of these as the lagging indicators of moat. Lagging. Okay, so if you see that a business is consistently able to deliver on both these two metrics, okay, then you may be able to conclude that this business has moat. Okay, but we got to understand what are some of the drivers, okay, that or some of the factors or metrics that a business has, okay, okay, which lead to, okay, growth and ROIC. So essentially, what I'll take you through is some of the leading drivers, leading indicators of moat. Okay, right. So these are the lagging indicators. What we'll discuss is some of the leading indicators of moat, and we'll use it for we'll apply that framework for to Workiva. That's what we'll do. Okay. Right. So this is the framework that I use to assess moat in a business. Okay. Let me not drain you through it right away. Let me just apply this framework on Workiva. Okay. I think that's a better way to kind of understand not only the framework, but also appreciate the moat which is there in Workiva's business. All right. So let me jump to the second segment, which is let's look at the drivers of moat in Workiva. All right. So as a reminder, what Workiva is, what it does, see, you got to understand that organizations, enterprises, they need continuous access to live and accurate, traceable financial and non-financial data at all times. Okay? Because they want their disclosures, their reporting to be report ready, audit ready throughout the year. Okay? That is what Workiva does. Okay. All right. So what it does is it takes in data from disparate multiple source systems, ERPs and siloed databases. Okay. Both financial, non-financial, ESG databases, and then uh, it kind of unifies them in one platform, okay, using which it is able to generate these SEC filings and other regulatory compliance disclosures. Okay, so and all these disclosures, as I said, these are audit grade. These can be audited. Okay, and you could always trace back any data point from where it came. Okay, so data points are traceable and they're audit grade. So now the first driver of moat for Workiva, in my opinion, is product differentiation. Is the first driver of moat is product differentiation. And this is my view. And so based on whatever I could lay my hands on, whatever I could read, whatever I could research, okay, is that Workiva, one of the key differentiation points in its product is it has a connected platform. Okay, so what it does is Workiva, it combines both financial, non-financial reporting, all the financial, non-financial disclosures, okay, and the audit trails into one connected ecosystem, okay, which is then used to generate auditable reporting, auditable outputs. Okay. Now, the word connected is important here. I'll tell you why. So what I have here in this slide is I have pulled in snippets, okay, from some of the commentary from Workiva's CEO from the latest earnings call. Their CEO is Julie Isco. Okay, so if you see the highlighter, again, don't intend to bring you through everything. Okay, it's a busy, I know, busy slide, but just look at the highlighted portion. Okay, so the platform differentiation is kind of evidenced in the way Workiva has been winning work. Workiva has been winning deals. If you look at the highlighted snippet here, it says, Julie, the CEO says, following a highly competitive process, our clients, they chose Workiva over multiple point solutions because of our ability to serve as a definitive system of truth. Okay? So again, they recognize that no combination of disparate vendors could replicate our platform without sacrificing connectivity, collaboration, trust. So again, so she's referring to the connectedness of the platform. So you kind of replace multiple point solutions with one connected platform. You don't need to have clients, they don't need to have multiple point solutions to take care of financial reporting, to take care of, let's say, non-financial reporting, ESG reporting, regulatory compliance. Everything could do in one platform, plus it's auditable, always auditable. Okay. And if you look at this snippet here, what she says is, she's talking about another client deal that they won. The opportunity also displaced a standard GRC point solution, further reinforcing the value of connected platform. Again, the key word is connected. Okay? And then if you talk about the third one, then again, she says, a particular client, they select Workiva because of our unified platform enables them to meet unique reporting needs. Okay? So on and so forth. So again, the differentiation is kind of evidence in the way they have been winning work. That is my larger point. And the key platform differentiation, product differentiation is because they have a connected platform, plus it's the reports they make are auditable. Okay, they are always audit ready. All right. So the second driver of Moat, second pillar of Moat, is the incredibly high switching cost. Okay, is the high customer retention. Okay, which is evidenced in this 97% gross revenue retention. So what is gross revenue retention? See, gross revenue retention is see of the revenue that they had a year ago, what portion of that revenue they have been able to keep, they have been able to retain before counting any upselling. Okay, so what means is that only 3% of the existing revenue it has been lost to churn. Okay, they have been able to retain 90% of it, which is incredibly high in this industry. Okay, so and they have been. If you look at this snippet chart, which I pulled from their investor presentation, okay, or investor day presentation from last year, this 97% has been constant through the last several quarters. So it's not a one-time stickiness rate. It has been there for since many quarters. Okay, so that's incredible customer stickiness is what we're talking about, right? Because see, customers, they just cannot afford to flip to a different vendor mid compliance cycle because it would cause a lot of disruption. Okay, so that's why the likely outcome is the customers, they renew their contracts. They may renegotiate or they may even expand the contracts, as we'll see. All right, so this is the second pillar of Moat. Okay. All right. Now, so the third pillar or driver of Moat, as per my research, is that they have an edge over competition. Okay, so they have three categories of competitors. The first category, they face head-to-head competition with Donnelley Financial. So Donnelley, again, this may be a crude oversimplification, that they're more like a white glove service firm which helps with the financial filing, with filing of financial disclosures. Okay, and again, at the risk of repetition, this may be a crude oversimplification. Okay, and they're more so present on financial reporting and than on non-financial reporting. And most of the clients, they are clients which are going for an IPO, so for one-time events. All right. Now, Workiva also has clients, from the capital market space, clients which are going for IPO. Like a prominent one of the example is SpaceX, Cerebras, and there are of course others as well. Spaces, of course, is a very large, complex enterprise, right, which went for IPO. So it kind of it proves that Workiva has credential in this space as well. Okay. Now, so Donnelley is a little priced a little cheaply vis-a-vis Workiva. So that's something that to keep in mind. And the second category of competitors that I have noted is the ERP suites like SAP Oracle. Now, SAP Oracle, like for SAP Oracle, they have their last mile uh, regulatory disclosure filing software. Okay, so they could be a credible threat. Okay, because not only, of course, they own the source data, but of course they are into last mile, as I said, regulatory reporting as well. Okay. Now, so although it seems like they're a credible threat, but we got to keep in mind that many of the enterprise clients, okay, they have multiple ERP systems. Okay, they have multiple source systems. Okay, we live in a heterogeneous environment, right? So they'll have multiple systems, right? So Workiva. The good thing about Workiva is that it works with it's basically system agnostic. Okay? It doesn't care what the source system is. Okay? So let's say if a company only had, let's say, SAP or only had Oracle, okay, then yes, those companies, okay, may very well leverage the regulatory filing software provided by SAP or Oracle itself. But again, at the risk of repetition, we live in a heterogeneous environment. A lot of companies or enterprises, for the most part, they have multiple disparate ERP and other systems, right? So which is where Workiva, of course, Workiva works with everyone, right? So that's why I believe Workiva is not going anywhere. It's very much here to stay, right? Because of heterogeneity. Okay. All right. That's a category two. Third category is, and these are not direct competitors in my view. So you have like point solutions. So see the buyer the buyer for companies like Workiva, okay, and Point Solutions, Blackline, and Vertex. The buyer is the office of the CFO. Okay, that's the key buyer, office of the CFO. Okay, now Blackline is a software that's focused on accounting close. Vertex is focused on tax. Okay. So they are adjacent solutions. They are not necessarily, they provide the same offering as Workiva. So they are in the adjacent space. Okay. So again, but they could be potential threats if they were to, let's say, encroach on what Workiva is doing already. Okay. But for now, they are not threats per se. Okay, but all of these solutions, Black and Vertex, they compete for the office of the CFO budget. All right, that's how I would summarize. All right. So, anyways, larger point being, I do believe that the Workiva has a slight edge over competition, and again, that's being also kind of proven because Workiva has been able to displace multiple point solutions, as we saw in one of the earlier slides. Right. That's how they are winning work. Okay. So let me move on. Right. So on the driver of moat in this business is regulatory demand, right? Okay. So it's kind of an obvious one. Okay. So SEC reporting in the US, ESMA in the UK, in Europe, right? So these are kind of obvious one. And then of course, so this is financial disclosures, and then you have SOX compliance, the GRC, so risk compliance, right? So this is of course the second one. Third is which is playing out in Europe. So Europe, you have a stringent ESG sustainability criteria, right? So which has put tens of thousands of companies to deliver mandatory and auditory or audit grade non-financial reporting, right? So this is a huge demand driver playing out in the European region. Okay, but there's a risk here as well, which I'll cover in a subsequent part of the video. Okay, so again, these three are drivers of moat, and if you look at the snippet that I've pulled from the earnings call transcript, okay. So what it says is that CFOs expect sustainability disclosures to be held to the same standards as financial reporting, with the same traceability, audit controls, and assurance, right? So that is what is driving demand for Workiva in from this ESG space. That's acting as a significant catalyst. Okay. So, in fact, what I've done is I have estimated the serviceable, addressable companies that likely need Workiva's multi-category, multi-solution. Okay, so let me just go there and just. All right, so I just pulled open a spreadsheet. Okay, so here I have attempted to kind of size Workiva's market. Okay, so total addressable clients across all the markets that they operate in North America, Europe, and APAC. I don't have LATAM; they also are present in LATAM, but these three markets is a little over 28,300 clients, addressable clients, right? So in fact, I may have been a little conservative. Okay, and these are serviceable addressable clients. It's not a total market; these are the serviceable addressable market, right? So these are the clients which potentially could buy Workiva solution. Right now, Workiva has been able to penetrate around 6,700 of all these clients, right? So there is a runway for growth in terms of acquiring more client logos, right? That's the larger point. Okay? And it's being driven by, in Europe, it's largely being driven by the ESG sustainability requirements, right? Which in that market. Okay. And as I said, there is also a certain ESG is an evolving thing. There was an omnibus directive that came out recently, okay, which had actually reduced the number of companies which earlier could have used Workiva's solution. Okay, so there is also a risk as well. But having said that, still, despite that directive coming into play, okay, still the addressable number of entities or companies that could adopt Workiva solution is still pretty significant. All right. Okay. So again, that's to kind of show you the total the serviceable market for Workiva and what are the factors which are driving the market size for Workiva. Right. So that's it. Let me go to the next slide. All right. Let me go to the next slide. So next driver of Moat is pretty interesting. It's their land and expand strategy, which is working out very well for them. All right. Okay. So land and expand has led to cohort value expansion. Let me walk you through what I mean by that. Right. So what they do is first, when they land upon a client, they sell, let's say, a solution from one category, which is, let's say, SEC filings. Okay. And then once they have acquired that client, gradually they are able to expand, they're able to sell solutions from other category to that same client. Okay. And then they are able to expand further. Okay. They are able to sell, solutions from a third category, which is ESG. Okay. So that's how, and this strategy has worked out very well for them. Okay. Which has led to cohort value expansion. Okay. So if you look at their net retention rate, it's consistently of 110. Okay. So what it means is, okay, that the clients, they are buying the same client, they're buying more and more solutions from Workiva. And in fact, if you look at this table that I have, it's a busy table. So I'll just draw attention to specific points here. So although Workiva has only modestly yet consistently grown the number of clients, they are every last 3 years or so, 2 years or so, they have been adding 300 clients every year. Okay, so right now, as I said, they are at what, 6,700 clients. Okay, right. But and as I said, the growth in the client logos has been modest yet consistent. Okay, but if you look at the number of clients with an annual contract value of less than 100K, okay, that number has actually degrown. Okay, what does it mean? It means that they have been able to push those clients, okay, into buying more and more solutions from them. Okay, so those low value clients have become gradually they have become higher value clients. So that's the reason why there has been a slight reduction in the clients in the 100 less than 100K annual value. Okay, so if you see, there has been a consistent growth in the clients, okay, in the higher cohort value. Okay, consistent growth in customers with higher annual contract values. Okay, that's a very telling point. Okay, now if I go further, just want to make sure it's getting recorded, right? Yes, it is. Okay. So if you look at clients with an annual contract value of 100K, there has been consistent growth across all cohorts. Okay. So again, it reinforces the point that clients are buying more and more. So right now, their annual contract value on an average is around $149,000. All right. Okay. And again, if you look at the net retention rate, which is consistently above 110, which is what I covered in the last slide. Okay. So this shows that cohort value expansion is certainly playing out. Okay. Now they have what, 6,700 clients, right? Okay. Times the annual contract value on an average per client is 140K. So if you do the math, you do this multiplication, total revenue right now, what they make is around close to $9 billion. Okay. That's their total revenue right now. Okay. So my point being, their growth is driven by two things. One is the increase in client logos, but that growth is that increase in client logos is slightly modest. Okay. The second driver of growth is those same customers, those same client logos, buying more and more solutions across different categories. So they have been showing a lot of good growth as a combination of these two factors, despite the increase in client logo being slightly modest. All right. So again, in my opinion, that's a major driver of moat for this business. Is the land and expand led cohort value expansion. So the final driver of moat that I have listed for this business is AI, because I believe AI is not a headwind but more of a tailwind for them. But I have a question mark, okay? Because of course there could be opposing schools of thought. Okay? The reason why AI is rather tailwind, not a headwind, okay, is, see, because if you have AI creating super critical compliance disclosures for you, okay, then the need for Workiva's software only increases. Okay, because AI, let's say, may hallucinate. I'm sure, of course, it will get better with time. Okay, but still uh, there is still a chance that it may hallucinate. So you have to have a software like Workiva, okay, that you can trust, because of course the reports that they generate, they produce, they have prominence. You can track a data point from start to finish. And of course, their reports are audit grade. Okay. So I think AI would only increase the demand for Workiva's software. So that's one, which is what I've listed here. Okay. Second is Workiva's revenue is shielded from uh, headcount reduction. Okay. Right. Because they do not have seat-based pricing. They have value-based pricing. So as I covered in the beginning of the video, a lot of software firms, they're scrambling to pivot away from from seat-based pricing to value-based pricing. Okay, but Workiva has been in value-based pricing since 6-7 years now. Okay, and their CEO has time and again confirmed that we are not seat-based. So I have a snippet from their latest earning call transcript. All right. So again, so that's why I believe Workiva is very well placed to kind of so so AI, they're not playing AI defense. I would not go as far as saying that they are playing AI offense. I would not say that. But what I would say is they are very well positioned to capitalize on AI or deal with AI. Okay, as opposed to some of the other software firms, enterprise software firms, companies out there. Okay. All right. Now let's also look at some of the risks in this business. Okay. So 1 second. Right. Now, there is, of course, I don't want to rule out AI commoditization. Okay. There are, of course, different schools of thought. Okay. So AI commoditization may be a risk. In my view, it isn't. Okay. But yeah, that may be a risk. There are opposing schools of thought. Okay. Regulatory softening. Okay. As I said, in the Europe, okay, there are a lot of stringent criteria on sustainability, on ESG. Yeah. It's not that those criteria are not there elsewhere, but Europe is a little more stringent some of the others. Okay. But recently they had an omnibus directive that came in. And as per that directive, uh, the stringent ESG criteria, reporting criteria, applies to only larger companies, okay, which reduces the addressable number of companies that Workiva can tap into in Europe. Okay. But still, that's still a pretty significant number. It's not a small number. Okay. So, but again, this is regulatory, is of course is an evolving thing, right? So you got to keep tabs on this all the time. And then of course competition, right? This is something that I've covered already. But let's say if your point solutions like Blackline, Vertex, some of the other solutions out there, they encroach on Workiva's territory, then they may pose some risk in the future. But I don't think right now they are a risk. And ERP systems like Oracle, SAP, there is a school of thought that they are credible risk to this company. But my opinion is that they are not risk per se. Heterogeneous environment. We live in a heterogeneous environment, sorry, okay, where companies have multiple ERP systems, large enterprises. So those large enterprises will continue to have Workiva as their vendor, okay, because Workiva can work with is system agnostic. Okay. All right. So this is my view on risks. Now let's summarize all the moats, right? All right. So in summary, Workiva's product is differentiated, high switching costs, something that we discussed, edge over competition, demand driven by regulatory requirements, land expand strategy, which is working very well for them. Okay. And then their AI is more of a headwind, more of a tailwind than a headwind. And of course, their pricing is decoupled from headcounts, right? So all these are drivers of moat, as in my view. All right. Now, so now with that said, now let me just flash my framework, okay, that I use to assess moat, and you would see that how I applied my framework at Workiva, because I've already discussed the pillars of moat. Now let me flash my framework that I use. All right, so this is the framework that I use to assess moat in the business. Okay, so if you see here, I have listed the key drivers that I look for, okay, in a business. All right, okay, and then all these drivers, okay, combined, they should lead to two things. One is revenue growth, okay, and then ROIC. So growth is something that Workiva has is seeing a lot of good growth. Okay, I know I did not take you to the exact ROIC figures, but my larger point being, okay, if I talk about this framework, then all these drivers of moat should lead to growth and ROIC. All right, so that's how we judge moat in a business. Okay, now uh, if I talk about how I apply this framework, okay, so I always have this framework in my back pocket, okay, when I'm assessing a business, when I'm trying to assess what are the moat in the business. So I have this in my back pocket. So we talk about the first one, the cost advantage. I know I did not discuss cost advantage, but this business, Workiva, has shown a lot of operating margin improvement over time. Okay. In fact, they have been able to beat their own expectations, beat their own guidance. So this is something which is playing out beautifully for them. Okay. And then the next one is product differentiation, something that we've discussed at length already. So I believe they have a differentiated product. Okay. All right. So, and there is evidence to demonstrate that. Okay. Then distribution. Okay. Now they are very well entrenched at some of the large clients, right? So if I show you a quick screenshot, if you look at this, if you look at the screenshot, okay. So if you see, they are present in 85% of the Fortune 1000 companies. It speaks to the kind of entrenchment, the market leadership, the market dominance that they have, right? Okay. And totally, they have what, around 6,700 customers, right? Uh, across the Americas, Europe, and APAC. Okay. The bulk of the customers coming from North America, at least right now. Okay. All right. So distribution, the entrenchment that they have is another driver that's playing out for them. Switching costs, something that we have discussed already. Okay. They have very high retention rate, okay, industry leading retention rate. Okay. And then if I speak to some of the Potter's forces, if you look at a competitive rivalry, so as we discussed, as per my research, as per my opinion, they do have a slight edge over competition. Okay. So, and then threat of substitutes and threat of new entrants. Now, AI commoditization is a risk. Okay, but again, as I discussed, that AI, as per my opinion, there are two schools. My opinion, as basis what I've researched. Okay? AI is actually more of a tailwind than a headwind. Okay, right. So these are the same drivers of moat, probably just worded differently. Okay, which are leading to both growth and ROIC expansion. Okay, right? So let's say if a firm or Workiva in this case is able to demonstrate both growth and ROIC for a prolonged period of time, then certainly it will set to have moat. Okay. So, let me qualify what I mean by prolonged period. Okay, so research houses like Morningstar, what they've said is, okay, that any business that's able to demonstrate growth and excess return on capital for 20 years or so, then that business is said to have a wide moat. Okay. Now I don't have the kind of foresight to to go beyond 10, 15 years. I can't think beyond 15, 20 years. Okay, because software and technology, they are ever evolving. Okay. So and not even attempt to go far in the future. Okay. But what I can say is that because Workiva has demonstrated industry leading customer retention, okay, they have evidenced land and expand sales motion. Okay. And because of all the other drivers of moat that we've discussed. Okay. So to me, it seems Workiva should be able to deliver on growth and excess returns on capital at least for the next uh, 10 years. Okay. It's just hard to put a number. Okay. But let's just say at least for the next 10 years or so, okay, it should be able to deliver on excess returns on capital. Okay, if you think about it, okay, Workiva is experiencing operating leverage. Okay. In fact, management has guided that in the next 4 or 5 years or so, they should have they should be able to expand their margins further. Okay. And in fact, they've exceeded the guidance the past year. Okay. They've exceeded their own expectations. Okay. So any incremental operating leverage, operating margin expansion should trickle down to ROIC. Okay, because ROIC is made up of operating margin and capital efficiency. All right. So and yeah, growth we've already discussed. They have a good addressable market ahead of them. So they have good opportunity ahead of them that they can capture, both in terms of acquiring new client logos and land and expand. Okay. So this is what I've used in my valuation, something that we'll discuss next. Okay. So I'll walk you through the outcomes of my DCF valuation. Okay. And how I leverage what I discussed in that valuation. Okay. But very quickly, let's first look at relative valuation, and then we'll jump into how I've valued, how I have used DCF valuation to value this business. All right. So first, let me take you through the relative valuation. If you're a budding investor interested in learning thorough fundamental analysis and valuation, or if you're an aspiring equity research analyst, financial analyst, or a consultant who's interested in learning these skills to get into such roles, okay, then I have a program suited to your needs. Okay? In my equity research and valuation learning program, I cover quality and well-researched content. I cover diverse industry business models. Okay, and I have a growing community. Okay. So, and I also have the list of topics which I cover, which on the slide, which will help you become a well-rounded, thorough analyst. All right. So get in touch if you interested in learning more details about this program. All right. Thank you. All right. So I have the relative multiples, I have the valuation multiples of Workiva and a few of its adjacent peers. So if you see both on an EV by revenue and rule of 40, Workiva is trading at a premium vis-a-vis the listed players out here. Okay. So in terms of revenue multiple, its enterprise value is 3.5 times revenue, okay, which is again at a premium vis-a-vis listed peers or listed adjacent peers rather. And the rule of 40 basis, okay, again, it scores higher than the peers that I've listed here. Okay. So basically it's trading at a premium vis-a-vis its adjacent peers. And premium valuation is justified because see, Workiva has durable moats that we just discussed. It is able to expand its operating margin and through scale and execution. The premium valuation vis-a-vis all these peers is justified. Okay. Now let me spend a minute on what I mean by rule of 40. Okay, right? So mechanically speaking, how do you compute rule of 40 valuation metric is you just combine the year-on-year revenue growth with free cash flow margin. Okay. So last year, Workiva, I think experienced a growth of around 18%, okay, revenue growth. And the free cash flow margin was closer to 16%. So 18 to 16, that's how you get 34. Okay. Now, so this is how you compute the rule of 40 valuation metric. Okay. Now let's understand how to interpret it. Okay. Now, see, early stage or high growth SaaS businesses, okay, they often burn cash to acquire market share. Okay. Now, just one second. I just want to make sure I'm getting recorded. Yeah. So early stage or these high growth SaaS businesses, they often burn a lot of cash to acquire market share, right? So the rule of 40, it ensures that if a company is burning cash, okay, then its growth rate, okay, is fast enough to justify that spend. Okay, because if in case the growth slows down, then operating leverage should ideally kick in to generate healthy profit margins. Okay, so basically, rule of 40 helps you assess if there is a balance between growth and profitability. Okay, you need growth and profitability both. Okay, all right, and the sum of them should be 40 or near 40. Okay, so Workiva is at 34. Okay, but all the other firms they are of course little further away from 40. Okay, so what it means is that Workiva to an extent has been able to balance growth with profitability. Okay, that's what it means. Okay, vis-a-vis other listed adjacent peers. Now, let me get to the last part. Let me walk you through the outcomes of my DCF valuation. All right. Okay. So if you recall, let me just go back up. If you recall, when I discussed the value framework, okay, what I said is, to value any business, we need three essential ingredients. One is, of course, operating margin, a view on how those margins will pan out in the future, what those margins are right now, how those margins will pan out in the future, capital efficiency, okay, and then revenue growth. And of course, combination of margin and capital efficiency is ROIC. Okay, and then of course, you also need to understand how the firm will grow in the future. So these are three very important gradients that you need to value any business. Okay, now, so if I, and of course, I've spoken at length about margin and ROIC and revenue growth. Okay, so now let me talk about my assumptions on these three metrics. Okay, right. So for revenue, okay, right now this business is at 0.9 billion. Okay, I've assumed that it will be able to acquire around 250 logos every year for the next uh, 4 5 years or so, consistent with history, in line with history. Okay. Plus, not only client logos, it will be able to further deliver on its land and expand strategy. Okay. So combination of these two, it will be able to grow its revenue to 1.7 billion. Okay. And I have the underlying spreadsheet in which I've done this math. Okay. In fact, the entire valuation. Okay. Not taking you through that. Okay. But just the outcomes. Okay. So, in fact, the management said they are expecting the revenue to be closer to 2 billion. Okay. But I'm a little conservative. Okay. So this is how I've modeled revenue. Plus, I expect that probably over the next 10 years or so, they'll be able to add another billion. Okay. All right. They'll be adding fewer client logos, and plus land and expand will gradually, of course, they'll continue landing and expanding. But I've assumed a modest land and expand. Okay. All right. So again, so what I'm expecting is over the next 10 years, they will be under 3 billion in revenue. That's my revenue estimates. In terms of margin, I'm assuming, I'm estimating that they will be at a 11-12% operating margin 4 years from now and 15% in next 10 years from now. Again, this is consistent with management's guidance. In fact, management guidance is a little more optimistic, and management themselves, they have far exceeded their own expectations, right? So I believe I may be a little conservative. Okay. So anyways, these are my revenue and margin assumptions. And capital efficiency right now is 2. That's for every dollar they invest, they generate $2 in revenue. Okay. So capital efficiency, for the most part, I've assumed it will stay put. Okay. Now, combination of margin and capital efficiency is ROIC. Okay. So my DCF valuation, in a way, it assumes a 4-year transition to scale driven operating margin expansion. Okay. All right. So which will lead to sustained excess returns on capital. Okay. For this forecast period. Okay. Because of, as I said, high switching costs and evidence, sales and expand motion. All right. So these are my assumptions. Using these assumptions, okay, I find this business to be reasonably valued right now. Okay. Again, I may be conservative. Okay. If let's say I was valuing this business a week ago, yeah, I was saying if I was valuing this business, let's say a week ago or a month ago, then I would have found it severely undervalued. Severely undervalued. Right now, I would say it's close to fairly valued. Okay. And the fair valuation is around 37.5 billion, which is the market cap it's trading at right now. Okay. Under $4 billion. Okay. So I'm not saying this is a bad time to enter. In fact, this may be a very good time to enter. This is not an investment advice. I'm just saying that this may be a very good time to enter, given the long growth runway and margin expansion ahead of itself, ahead of it. All right. So if I were to conclude, I think this is a very interesting business. Okay. Very interesting business. It's, so while all the other enterprise software firms are scrambling to kind of play AI defense, they are not doing that because they were already they were not doing seat-based licensing. Okay, they are doing value-based pricing. Okay, and they have durable moats as we discussed. Okay? Plus the regulatory tailwinds. Okay, present a long window of opportunity as I discussed. Okay, and AI is more of a tailwind than a headwind in my view. So all of these factors combined makes me believe that this is a long-term compounding opportunity. All right, very interesting business. All right, now let me. Right. So with that said, we have come to the end of this video. Okay. Right. So in summary, just to conclude, what we discussed in this video is we started first with discussing enterprise software businesses, the key risk that they face. Okay, we discussed that and how Workiva is very well positioned against that risk. Okay? And then we discussed Workiva at length. We first discussed the value framework. That value framework is foundation to business analysis and valuation itself. Then I took you through the framework that I used to assess moat in the business. Okay? We discussed the various drivers of Moat which are at play for Workiva, okay, and how this business is differentiated. Okay. And then we discussed the relative valuation for Workiva, and then I walked you through the outcomes of my DCF valuation of this business. Okay. So hope this was a good session, and hope you enjoyed it. Please write to me if you have any questions. All right. Thank you. If you're a budding investor interested in learning thorough fundamental analysis and valuation, or if you're an aspiring equity research analyst, financial analyst, or a consultant who's interested in learning these skills to get into such roles, okay, then I have a program suited to your needs. Okay? In my equity research and valuation learning program, I cover quality and well research content. I cover diverse industry business models. Okay, and I have a growing community. Okay. So, and I also have the list of topics which I cover, which on the slide, which will help you become a well-rounded, thorough analyst. All right. So get in touch if you interested in learning more details about this program. All right. Thank you.